Hi, this is Nash with Alpha Phi. Please hit that like, subscribe, and you won't miss any videos I release in the future. So, in prior videos, I have been mentioning the MassMutual 10-Pay product. It is a very interesting product in that you have a very high performing dividend scale cash value growth. So this is probably one of the highest net IRR cash value growth products that I've seen out there, and MassMutual is a great company with a proven track record of performance delivering value to policyholders. But it's not all rainbows and ponies. There are some drawbacks to the 10-Pay product and the 12-Pay for that matter that I wanted to share and go into a little more detail of, particularly as it relates to losing a little bit of flexibility and some nuances with the ALIR PUA rider. So first, the 10-Pay has a guaranteed rate of just 2%. That is very low for whole life products, and the reason is it's squeezing those guaranteed rates down, the death benefit down as well, and it allows for very high working capital for investment for longer term potential returns. So that is why we have such a high net IRR on cash value growth potential, right? Dividends are always potential. Whole life companies have paid dividends very consistently, especially the big ones, for a very, very long period of time, over 150 years. However, it is not guaranteed. It is based on the insurance company investment portfolio and those returns. But there's more working capital being put in for your potential returns. That's why it's a higher netting product for you. But let's look at the design. What makes it different? Most MassMutual products that are not the 10-Pay or the 12-Pay, we combine LISR, which is a PUA rider blend with a term rider, to allow for us to raise up the death benefit, raise up the MEC limit to allow for funding at a 1090 contribution limit of base premium to PUA. And LISR, particularly, that blended product, will allow for us to bounce our payments up and down year over year. So you have to pay what you want to pay on your policy anniversary date, but you can bounce those payments up and down year over year without having to go back through medical underwriting. When we don't have LISR attached, which with the 10-Pay product and the 12-Pay product with Mass, we don't add LISR because it really hinders the growth. So we leave that off. We combine the base premium with ALIR, the additional life insurance rider, and RTR, Renewable Term Rider, and we leave off LISR. The reason is the net cash value growth is much greater, but it comes with some implications we want to consider. The flexibility is less because we don't have that LISR attached. So with no LISR, if you bounce your payments up and down on your policy anniversary date, it could impact your ability to fund the policy, the ALIR contributions particularly. It may reset your max contribution limits, or it could require you or trigger you to go back through medical underwriting, reestablish your ability to contribute into ALIR. So we want to avoid that. Let's look at how we can do that. So for best cash value performance, again, we aren't using LISR for the 10 and the 12-Pay with MassMutual. So ALIR is a pure PUA rider. We have some rules we need to follow. You can and should consider this a bill that is the same time as your policy-based premium due date on your policy anniversary. You really, really want to make sure you can make your payments for years 1, 2, and 3. They're very critical for opening up a little bit of flexibility. So it's less flexible with just ALIR. However, if you make those first 3 payments at your target funding, then it can open up a lot of flexibility. After hitting those 1, 2, and 3 years, Mass will allow you to go 2 years with reduced ALIR or no payments before requiring medical underwriting. So this gets a little complicated, but if you miss 2 years, you can put 0 into ALIR. So let's just take an example. 50,000 max contribution limit for, let's say, 10 years, 10-Pay product. $5,000 going to be your base, about 45 going into ALIR and RTR. Let's say we contributed 10,000 total. So 5,000 in years 1 and 2 to base, $5,000 to ALIR and RTR, $10,000 total for 2 years. Year 3, you can pay the full amount into the ALIR plus any PUAs missed from the prior 2 years, and you can essentially reestablish your ability to contribute $50,000 from years 4 and on. So in years 1 and 2, we did $10,000 and $10,000. In year 3, we missed 40 from year 1 to ALIR, 40 from year 2 to ALIR, and we contribute 50 total for year 3 plus the 40/40. So you can put a total of $130,000 in year 3 for that year 3 total amount due, plus years 1 and 2 makeup payments. That will reestablish your ability to continue from year 4 and on at 50. Okay. If you don't continue to contribute or make up after those first 2 years, if you go down to 0 and 0 and then some other reduced amount, your ALIR will then reset to however much you put in that 3rd year. Okay, so it'll reset it to a new max contribution limit. Otherwise, if you want to go higher, you may have to go through medical underwriting again. If you miss putting in any ALIR payment in that year 3, then you have to go through medical underwriting, and your ability to contribute to ALIR is wiped out. All right, a little confusing, but definitely less flexibility than having LISR on there, and some nuances to consider. It's not all bad with ALIR. ALIR is a pure PUA rider, which is a pure cash dump-in, which I really love. And there is a unique benefit with ALIR. You can do ALIR increases. So if you are able to make those 1, 2, 3 year PUA or ALIR payments, then you can start increasing your ALIR contribution by 10% every year thereafter if you want to pay in more. And you don't have to go through medical underwriting. It is really important, if you do intend to do this, to have your agent design your policy to allow for those increases so you don't mech your policy. So if you want it, make sure your agent knows so that they can design it appropriately and allow for you to contribute even more into ALIR, meaning your base premium ratio to PUA dump-in is going to be, your base premium dollars contribution is going to be getting smaller, your PUA is going to be getting larger, therefore your cash value is going to exceed and grow even more exponentially. Okay, and then a common question I get is on these limited paying products. Can I continue to contribute after the limited premium paying period? So the limited premium paying period is for base premium contributions. You can still contribute to the PUA riders after the base premium paying period. So for example, a 10 pay is paid up and no more base premium is due after 10 years. You can continue to keep dumping into ALIR, for example, on that 10 pay. However, we need to make sure it's designed in to allow for contributing more into PUAs and 0 into base premium, maybe making sure the term rider's on there to raise up the death benefit to allow and continue to allow for PUA payments. Otherwise, we could mech the policy. So, you need to make sure it's designed appropriately, as always, but we can continue to contribute into the PUA riders on the Mass Mutual and others such as Guardian limited pay products. In the next video, we will look at some examples of how you can continue to contribute into the limited pay products with dumping into PUAs with some examples of actual policies with Guardian and Mass Mutual. So don't forget to tune in. That's it for now. Thank you and have a good day. If you enjoyed this video, please like and subscribe. Also, you can learn more at alphacrusaders.com at the link at the end of this video.